So let's take a look at Doman here. First, we'll just look at the question. This is from Alice, one of our YouTube subscribers. Alice said, I'm looking at some higher yielding stocks that have potential to do well as interest rates fall. A company I came across is Doman Building Materials. It has a 7% yield. Do you think that the dividend is sustainable? So I'm looking at two things here. One is the dividend sustainable? Two, is this company well positioned as interest rates fall? Is this going to be one of the beneficiaries of a declining interest rate environment? So let's take a look at this company, Doman Building Materials. So what they are a vertically integrated distributor of building materials and home renovation products, servicing construction, renovation, and industrial markets. So uh, traditionally, they've been known as a wholesale distributor of building materials like lumber, other types of materials as well. Interesting is that in addition to distribution, the company also owns and manages timberlands as well, um, as another segment of its business. So this is a vertically integrated supplier of building materials. The symbol is DBM on the Toronto Stock Exchange. It trades at a price of about 770, and it is yielding 7.3% right now. $673 million market capitalization as of today. So when we look at the 3-year chart on Doman, we can see, it's really kind of traded in a range, moved up and down over this period of time, but not really not really a recognizable consistent trend here. So primarily what investors have been receiving over this period of time is that dividend yield, that attractive income yield. So there's a few things that I'm going to look at here to answer Alice's question. One is I want to look at how the dividend compares to the earnings per share, cash flow per share from the recent financial performance, and just how the financial performance is trending. Then I want to see how the dividend compares, or if it's being covered by earnings and cash flow historically, how volatile the earnings and cash flow have been. And then I also want to take a look at the balance sheet. So these things are going to tell us, how sustainable the dividend is in the current situation that they're in. So we'll start off by looking at the recent financial results, Q2 2024. These were not very strong results at all. So sales down 3%, but adjusted EBITDA down 23%, and adjusted earnings per share down 41% to 20 cents. So big drop in adjusted EPS. Dividend payout ratio for the quarter was 70%. So that's up significantly over the same quarter last year, as we would expect, since earnings are lower, but still what I would consider to be reasonably healthy payout ratio, 70%. The company is covering its dividend with earnings, at least based on the last quarter. Now, if we look at how the company has performed historically, going back 4 years, and also as well over the trailing 12-month period, we can see trailing 12-month earnings per share, the blue column there on the far right, 73 cents compared to 56 cents in dividends. So still covering that dividend with some margin over the trailing 12-month period. And then going back historically, back to 2020, we can see some fairly significant volatility in financial performance here. The company's maintained a fairly stable dividend. And even though earnings have been volatile over this 4-year period, we can see in every year they are covering their dividend by what I would consider to be a fairly comfortable margin. So I have some concern here just in terms with how the earnings and the financial performance are fluctuating. I'm also noting that the trend right now is lower earnings in 2022 compared to 2021. Then again, another drop in 2023. Trailing 12-month earnings still again lower. So there is a negative trend in earnings, but certainly in every year they've been able to cover their dividends. So I'm not necessarily seeing anything here concerning regarding the dividend sustainability. But I do want to look at the balance sheet. So that's something that's very important. If they have debt to service, if they need to refinance debt at a higher interest rate, given the current interest rate environment compared to a couple of years ago. So debt for the company is about $810 million. And if you look at EBITDA over the last trailing 12 months, this would be a net debt to EBITDA multiple of 4.5 times. So we would consider net debt to EBITDA to be a key leverage ratio for analyzing the balance sheet. 4.5 times, I would consider this multiple to be high. So I consider this to be a highly levered balance sheet. Typically, I would want to see for a company like Doman, I'd probably want to see a net debt to EBITDA below 2.5 times, just given the company does have some cyclicality in its financial performance. Now, some companies, if you're in the utility space or REITs where you have more stability and visibility in terms of future cash flow, you can have a higher leverage ratio. But I wouldn't want to see for a more cyclical company like Doman a ratio this high. So I consider that highly leveraged, and this doesn't lend itself well to the long-term sustainability of the dividend, because if interest rates were to continue to increase, this is the type of company that could get into a lot of trouble. However, interest rates right now seem like they are not trending higher. It seems like they are trending lower. So this can actually be a good thing for a company like Doman building products. But just in summary, one thing we do like about the company is that in spite of it generating lower earnings in more recent periods and having fairly significant fluctuations in financial performance, this is a company that continues to generate solid earnings and cash flow year after year after year. So they're covering that dividend. They're maintaining a healthy payout ratio. I don't have any near-term concerns right now regarding the sustainability of the dividend. I don't see any major red flags. And the company is also very cheap from a valuation perspective. But there is the concern about financial performance trending down. And certainly the leverage being so high on the balance sheet would be something that would really cause us to kind of slow down and really look at that with caution. So the reason why I'm really not concerned about this right now is because we've seemed to turn the corner in terms of where interest rates are going. And now instead of going up, interest rates are going down. So higher rates were undoubtedly an issue for the company over the last couple of years. Even if you have fixed debt, you still have to eventually refinance that debt into something at a higher interest rate. And if you have variable rate debt, then you're incurring those higher interest rate costs essentially right away. So it has been a major net negative for a highly leveraged company like Doman to be in this environment of higher interest rates. And as well, higher interest rates have no doubt been impacting the company's end markets. So now as interest rates are going down, we would see this as being a net benefit to a company like Doman. That said, I don't like to invest based on, where I think interest rates are going to be in 1 to 2 years. There's just too many unknowns. I really want to look at the fundamentals of a business. So right now I'm seeing too much debt on the balance sheet. I would like to see that addressed. And I would also like to see some sign that the company is turning the corner and starting to produce earnings per share growth. But overall, the fundamentals aren't too bad in terms of the cash flow, just high financial risk.
I think it's a good summary. I think that like you said, interest rates are kind of a mixed bag for this company. They're coming down, which is likely a positive in terms of their debt, in terms of where in the future potentially their end market, building market will be. But the reason they're coming down, one of the reasons, is a weaker general economy, and one of the things we've seen being impacted first are companies that we monitor that are in the construction sector, and you've seen kind of guidance be lower, a weaker second half. And so is that going to go on with Doman? Is that why we're seeing weaker results right now? I mean, one company that Brennan will talk about today, right, is in the building industry, and they're looking at weaker. They have headwinds in the near term. Another company we were monitoring this morning that we may interview this week too, just had delays in projects and announced that, and the stock's down 20% today because essentially, you're seeing delays in building going in the near term. And so I would say with Doman, you've got that sitting in front of you, a weaker end market in the building segment in the near term, which is a negative. So, I mean, like Aaron said, maybe if you like the 7% dividend, it's probably decent right now. But even if you look back to 2008 on this company, the stock's basically in the same place it was then. So not not a lot of long-term growth in the share price. There is a solid dividend, but that's probably what you're getting in the near term, I think, Aaron.
Yeah. Yeah. I mean, I
Yeah.
think that you really want to look at this as a higher risk, higher yielding income opportunity right now. And there's certainly upside. I mean, if interest rates continue to trend down, which most people seem to think is going to happen for at least the near term, then there's potential for share price appreciation. I would just say investing like that, there is an element of speculation as well if you don't like all of the other fundamentals of the company.
Yeah, like one thing that I'd also add too is like, I mean, I can understand because it was like, in the wake of the pandemic, like the company did, I mean, Aaron showed it up on the screen in his one slide that the company ended up reducing its quarterly dividend from 14 cents to 12
Just
cents per
temporarily,
share.
yeah, for a couple
Yeah,
of.
just temporarily. So, I mean, seeing just that earnings are coming down, could there potentially be a decrease? I mean, and again,
Well,
what
if they
I'd like to
continue to
look at.
come down, then I would say that there would be.
Yeah, exactly. And
Yeah.
like that's the thing. I'd like to
If
look
they
like
start
even
to go
longer
back up
term.
again, then probably not.
Because like if we look back like long term, 10 years, like just to see kind of like the volatility in that dividend, if there's any, maybe it's been consistently growing over the whole time. But
No,
anyways,
it's
I
not
think that
been
that's
really
something.
a dividend growth story.
Okay, perfect.
Yeah. So yeah, no, I pulled up the history of it. It's been at 14 cents for over the last decade since
Okay, yeah.
2012.
Yeah.
And they did actually end up paying back those extra 4 cents as a special dividend for the ones they did
dividend.
miss. Yeah.
I did see
Which
the special
that
dividend.
wasn't uncommon with the dividend payers during the pandemic. Quite a few of them, they would cut or reduce during 2 or 3 quarters, and then they ended up paying it back as a special because really at that time no one knew how deep a recession would go at that time.
Yeah.
So it was really just capital management more than anything.
Well, thank you, Brett, answering my question in real time.